So, your US company just made a killing in Japan. Fantastic. But now comes the big question. Who gets to tax that profit? Japan, the US, or both? Today, we're going to break down the critical tax rules that could literally save your business millions.
You know, at the heart of all this is a really simple problem. When you succeed overseas, you suddenly have two countries, your home country and the country where you made the money, both wanting a piece of that same profit. It's a classic tug of war that can seriously eat into your bottom line if you're not careful.
Okay, let's make this super real. Picture it. Your company closes a huge deal, and bam, 100 million yen gain hits the books. That's amazing news, right? But almost immediately, that excitement is followed by a pretty massive question. Who gets a slice of that? Is it Japan? Is it the US? Or, and this is the nightmare scenario, is it both?
To figure that out, we have to start at square one. We need to understand the default rules of the game. So, before any special agreements or treaties come into the picture, let's look at what Japan's own domestic tax laws have to say. This is our baseline.
Japan's basic approach is pretty straightforward. For foreign companies, it uses what's called a territorial tax system. Now, what does that actually mean? Well, it just means that Japan's default position is to tax any income it considers to have come from within its own borders. It doesn't matter where your company is headquartered. If the money was made in Japan, Japan wants its cut.
And Japanese law is really specific about what it's looking for. It automatically goes after gains from selling things like real estate in Japan. It also targets the sale of a big chunk of shares in a Japanese company. That's what this 25/5 rule is all about. And finally, it looks at any gains connected to a physical business presence you have in the country, what the tax world calls a permanent establishment, or PE.
And listen, the stakes here are really high. We're talking about an effective corporate tax rate of roughly 30%. So on that 100 million yen gain we imagined, that's a potential 30 million yen tax bill just from Japan, right off the bat. That's a huge number, and it's exactly why you need to know what comes next.
So, the thought of paying 30% in Japan, and then maybe getting hit again in the US, probably sounds pretty terrible, right? Well, the good news is, there's a powerful tool designed to prevent exactly that. It's a special agreement between Japan and the US.
Think of this agreement as the ultimate tiebreaker. It steps onto the field when the laws of both countries would create an unfair situation, and it literally has the power to change the rules of the game.
This special agreement is called a double tax agreement, or DTA, and its whole job is to decide which country gets the right to tax certain kinds of income. But here is the most important part. Where the treaty's rules disagree with Japan's domestic law, the treaty wins. Every single time. It's the supreme law of the land in these situations.
Now, the treaty starts with this incredibly powerful default rule. It basically says that for a U.S. company, any capital gains are generally taxable only in the United States. That's huge. It means Japan agrees to step back and give up its right to tax. But, and you knew there was a but, right? Unless a specific exception in the treaty applies. And understanding those exceptions, well, that's everything.
So, to really see how this works in the real world, let's put the treaty to the test. We're going to walk through three really common scenarios, and you'll see exactly how the DTA plays out differently depending on the kind of asset you're selling.
First up, let's imagine your U.S. company owns a big office building right in the heart of Tokyo. You sell it, and you make that 100 million yen gain. This is probably the most straightforward example we can look at.
In this case, there's no fight. Both Japanese law and the double tax agreement are on the same page. The gain is taxable in Japan. And this makes sense, right? The treaty recognizes that the country where real estate is physically located should get the first right to tax it.
So what's the final outcome? You pay that 30 million yen tax in Japan. But then, to make sure you're not taxed twice on the same income, the US gives you what's called a foreign tax credit. This basically means the Japanese tax you paid directly reduces your US tax bill. Problem solved. No double tax.
All right, on to scenario 2. This one's a little different. Instead of a building, this time you're selling a huge block of shares in a hot Japanese tech company. Now remember, this is a sale that Japan's domestic law, that 25/5 rule, would normally tax. And this is where we see the true power of the treaty. Japanese law says, yes, that 100 million yen is taxable, but the DTA steps in and says, nope. It completely overrides the local law and makes that entire gain exempt from any Japanese tax. Zero.
The result here is just incredible. No Japanese tax is due. The right to tax that gain shifts entirely, 100% to the United States. By knowing and using the treaty, the company just saved itself 30 million yen. I mean, that is a massive win.
Okay, for our last scenario, let's say your company has a physical branch operating in Japan. That's our permanent establishment, or PE. And you decide to sell some of the assets that belong to that branch, maybe some machinery or computers, again for 100 million yen gain.
And here, we circle back to a result that looks a lot like our real estate example. Because these assets are part of a tangible physical business presence in Japan, the treaty agrees that Japan should be allowed to tax the gain connected to that presence. It just recognizes that strong economic link to the country.
And so the resolution is exactly the same too. Japan taxes the gain, and the U.S. provides that all-important foreign tax credit to make sure the profit isn't taxed fully by both countries. It's a fair, logical, and predictable outcome once you understand the rules.
Okay, so we've gone through a lot of details here. Let's step back and boil it all down to the most important part, a really simple framework you can use to think through pretty much any situation you'll face. It all comes down to the simple three-step checklist. But really, it hinges on one key idea. Does the asset have a strong physical connection to Japan? If the answer is yes, because it's real estate or part of a business branch, then Japan gets to tax it. For almost everything else, like shares, the taxing right swings over exclusively to the U.S. It's that simple.
But, and I can't stress this enough, there's one final crucial piece of advice. These amazing benefits from the treaty, they are not automatic. You can't just decide not to pay the tax. You have to formally claim your exemption by filing the correct paperwork with the Japanese tax authorities. Forgetting this step could be a very, very expensive mistake.
So there you have it. We've laid out Japan's default rules, we've seen how the treaty can completely change the game, and we've walked through the key exceptions. You now have the framework to understand who gets to tax your company's success in Japan. The only question left is, now that you know the rules, what's your next move?